Good morning, my name is Bianca Haywood and I will be taking you guys through PepsiCo's webinar. Please note that we won't be answering questions throughout the session. However, you guys are more than welcome to ask questions. We will be getting back to you guys via email correspondence afterwards. Please also refer to the webinar on how to interpret a trade note on the PSG website under tutorials. I'm going to start off with the recommendation. We feel that the share offers value on a relative basis, trading at a PE multiple below its peers, while on an absolute basis, the share seems to be fully valued, as its valuation multiples is well ahead of its historic averages. The share's EBIT margins is also on a high base, while its sales growth and net margin expansion is forecasted to lag its peers in the medium term. The continued shift in consumer preferences has seen consumers becoming more health conscious. Concerns around health and wellness continues to hamper volume growth, while sugar and salt content in the group's product portfolio is also subject to regulatory scrutiny in a number of jurisdictions. The success of the group's omni-channel will prove to be vital, given the disruptive shifts impacting its retail channels. The group also has a high weighting of impulse products in its portfolio. PepsiCo has consistently and will continue to be at the front end of innovation. The group will continue to focus on its everyday nutrition products, which include nutrients like grains, fruits, vegetables, or protein. PepsiCo will continue to focus on its broader guilt-free lineup with food with lower sodium and saturated fat content. Now moving over to the nature of business. Who is PepsiCo? PepsiCo is a global food and beverage company. The group has 22 iconic brands, which each generate revenue in excess of $1 billion in retail sales annually. The group's products is also available in more than 200 countries and territories worldwide. Now over to PepsiCo's financial results. The group released its second quarter results that were very much in line with management's expectations. The group also remains on track to achieve its full year 2017 financial goals. The results reflect the power and the durability of the group's portfolio. It is important to note that the results are presented on a core basis, which excludes three items. 1. The impact of commodity mark-to-the-market gains. 2. Restructuring and impairment charges relating to the group's multi-year productivity plan, and 3, the pre-tax impairment charge of $373 million in the previous year relating to the impairment of the group's 5% indirect equity interest in TAB Holdings to its estimated fair value. Net revenue increased by 1.8% or 3% on an organic basis, while food and snack volumes were up 2% and beverage volumes declined by 1%. Currently, roughly around 39% of the group's revenue is generated outside of the US, which means the group is exposed to foreign exchange rate risk. Unfavorable foreign exchange rate movements reduced the group's net revenue by 1 percentage point. The group's gross core margin contracted by 25 basis points, while the group's operating profit rose 4%. Accordingly, the group's core operating margin expanded by 15 basis points. Core EPS also rose 9% to 244 cents. The Brit-Vic gain had a favorable 6-cent impact on core EPS. Now moving over to divisions. I'm going to start off with Frito-Lay's North America. This is the group's second largest division in terms of revenue, while on an operating profit basis, it is the group's largest division. This division accounted for approximately 26% of the group's net revenue and 41% of its core operating profit. The division includes the group's branded food and snack business in the US and Canada. Net revenue growth of 3% was mainly driven by effective pricing. Volumes declined 0.5%, reflecting a double-digit decline in the group's joint venture products, a mid-single-digit decline in Lay's, and low single-digit decline in Doritos. This was partly offset by double-digit growth in Ruffles and high single-digit growth in a variety of packs. Operating profit grew by 5%, which reflected the effective net pricing and planned cost reductions across a number of expense categories. This was partly offset by increases in certain operating costs, higher commodity costs, specifically referring to cooking oil, which reduced the group's operating profit growth by 1 percentage point. Frito-Lay alone was the number one contributor to total use food and beverage retail growth by all $5 billion plus manufacturers to the end of the second quarter. Now moving over to the next division, North American Beverages. This is the group's largest division in terms of revenue. The division contributed 35% to the group's net revenue and 26% to core operating profit. This division includes the group's beverage business in the US and Canada. Net revenue increased by 2%, reflecting effective pricing. Acquisitions also contributed 1 percentage point to net revenue. Volumes were up slightly, reflecting the nominal contribution from acquisitions. Non-carbonated volumes increased by 4%, which reflected a double-digit increase in the overall water portfolio, which benefited from the introduction of Life Water. In just 5 months since its launch in the first quarter, Life Water reached 70 million in retail sales and is well on track to achieve its 200 million in retail sales on an annualized basis. Carbonated soft drink volumes declined by 3%. However, Pepsi Zero Sugar performed well, while the rest of the carbonated portfolio needs some work. Operating profit increased by 2%. This mainly reflects the planned cost reductions, the net revenue growth, and lower commodity costs, which contributed 1 percentage point to operating profits. Favorable settlement of promotional spending accruals compared to the previous year also contributed 1 percentage point to operating profit growth, as well as certain insurance adjustments, which also contributed 1 percentage point to operating profit growth. This was partly offset by certain cost increases. Now moving over to Quaker Foods North America. This division accounts for about 4% of the group's net revenue and 6% of core operating profit, and it includes the group's cereal, rice, pasta, and other branded food businesses in the US and Canada. Net revenue declined by 2%, reflecting the unfavorable mix and volume decline. Volumes were down 1%, reflecting a high single-digit decline in Ronnie, mid-single-digit decline in bars. This was partly offset by low single-digit growth in oatmeal. Operating profit decreased by 1%. Reflecting the lower net revenue and an increase in certain operating costs, as well as the exit of the group's MQD joint venture in the prior year, which negatively impacted the operating performance by 1 percentage point. This was partly offset by planned cost reductions, favorable promotional spending, which positively impacted the operating profit performance by 2 percentage points. Lower commodity costs also positively impacted the operating performance by 2 percentage points. The group also launched its was also the first to the market to launch its overnight oats in a cup, to capitalize on the trend of consumers preparing chilled oats in a variety of healthy ingredients. Now moving over to Latin America. This division contributed 10% to the group's net revenue and 7% to core operating profit, and accounted for beverage, food, and snack businesses in Latin America. Net revenue increased by 5%, reflecting effective pricing, which was partly offset by the refranchising of a certain portion of the group's business in Colombia, which reduced the net revenue growth by 1 percentage point. Snack volumes grew by 1%, reflecting a low single-digit growth in Mexico, which was partly offset by a mid-single-digit decline in Brazil. Beverage volumes declined 3.5%, reflecting a double-digit decline in Brazil, as well as Argentina, which experienced a low single-digit decline. This was partly offset by a low single-digit growth in Mexico and high single-digit growth in Guatemala. Operating profit decreased by 14%, reflecting higher operating advertising and marketing costs, as well as higher commodity costs, which negatively impacted the group's operating performance by 19 percentage points. In addition to unfavorable exchange rates, which negatively impacted the group's operating profit performance by 7 percentage points, as well as restructuring and impairment charges, which impacted operating profit performance by 6 percentage points. This was partly offset by effective pricing and planned cost reductions across a number of core expense categories. Now moving over to the next division, Europe, Sub-Saharan Africa. This division accounted for approximately 15% of the group's net revenue and 11% of core operating profit. It includes the beverage, food, and snack businesses in Europe and Sub-Saharan Africa. Net revenue increased by 6%, reflecting the effect of pricing and volume growth. Snack volumes were up 4%, reflecting a double-digit growth in South Africa, mid-single-digit growth in the Netherlands. UK and Russia also experienced low single-digit growth. This was partly offset by low single-digits decline in Turkey and Spain. Beverage volumes grew slightly, reflecting mid-single-digit growth in Nigeria and Poland and low single-digit growth in Turkey and France. This was partly offset by high single-digit declines in Russia and Germany and low single-digit declines in the UK. Operating profit increased by 49%, reflecting the effective net pricing and volume growth, as well as cost reductions across a number of expense categories. Additionally, the gain associated with the sale of the group's minority stake in Bidvik contributed 22 percentage points to operating profit. The impact of restructuring and impairment charges also contributed 8 percentage points to the group's operating profit growth. This was partly offset by certain operating cost increases, higher advertising and marketing expenses, as well as higher commodity costs, which reduced the operating profit growth by 10 percentage points. Now moving on to the next division, Asia, Middle East and North America. This division accounted for 9% of the group's net revenue and core operating profit. It includes the group's beverage, food and snack business in Asia, Middle East and North Africa. Revenue declined by 9%, reflecting unfavorable foreign exchange, which negatively impacted the group's operating performance by 11 percentage points. A net volume decline, which was partially offset by effective net pricing. Snack volumes grew by 7%, driven by double-digit growth in Pakistan, high single-digit growth in China, Australia and Middle East, and mid-single-digit growth in India. Beverage volumes declined by 2%, reflecting a double-digit decline in India and a mid-single-digit decline in the Middle East and Philippines. This was partly offset by double-digit growth in Pakistan and mid-single-digit growth in China. Operating profit improvement mainly reflects the 373 million impairment charge in the previous year, which reduced the group's value of its 5% indirect equity interest in TAB Holdings to its estimated fair value. Effective net pricing as well as the cost reductions also contributed favorably to operating profit performance. This was partly offset by higher commodity costs, which reduced operating profit growth by 24 percentage points, as well as a net volume decline and unfavorable foreign exchange rate movements, which impacted operating profit growth by 4 percentage points. Now moving over to the company's guidance or prospects. PepsiCo will continue to focus on transforming its beverage portfolio, including more non-carbonated options, reducing the sugar levels across its portfolio. Currently, approximately 45% of the group's net revenue comes from products which the group refers to as guilt-free. Management also indicated that the group is well on track to achieve its full-year financial targets of at least 3% organic revenue growth, which would be fueled by successful product innovation. Foreign exchange is expected to negatively impact the group's reported net revenue by approximately 2 percentage points, which is a 1 percentage point improvement from the previous guidance. Due to the improved foreign exchange rate outlook on earnings, the group now expects core EPS of $5.13. This represents an 8% increase on a constant currency basis. Management also expects raw material inflation, which would be mainly driven by an increase in the group's basket of commodities and additional pressure from transactional foreign exchange. Management expects core margin expansion fueled by its productivity programs. The core effective tax rate of 24%. Strong cash generation is expected to continue with approximately 10 billion in cash flow from operations, 7 billion in free cash flow, and 3 billion in net capex spending. Dividends is expected to be around 4.5 billion for the full year, and share repurchases of approximately 2 billion. Now moving over to the portfolio guidance. We believe that the group is a good quality company with a high return on equity, attractive margins, and historically good cash generation. The group also has an attractive dividend yield, which is supported by its high payout ratio, which we feel is sustainable. The strength of the group's brands, as well as its consistent and reliable growth, translates into a premium rating to the market. Despite these attractive fundamentals, we feel that the share is fully valued and would not recommend exposure to the share at current levels. That is it from me today. Please feel free to ask questions, which we will be answering via email correspondence. Thank you. Enjoy the rest of your day.